Good morning, ladies and gentlemen. The elections are over and we have repriced equities by exactly the amount I thought they would reprice, which is between 4 and 5%, on the expectations of lower corporate taxes and corporate taxes going down to something like 15%. So I think equities have probably done everything they're going to do for the time being, and I shall go over that in more detail later. But the score of the risk dial keeps on rising, and therefore you can see here that we're almost bound to get a crossover in the next few weeks and go into risk on. Now, I have been against the risk off all year, and I'm beginning to be against the risk on from now on, because I think we need a period of, I wouldn't say bearishness, but I would say stability in time at worst, or rather at best, and we might even have some retracements in equities. But still, it will be a continuation of risk on overall, because I've been bullish all year and I continue to be bullish. It's just that tactically I think this is precisely the wrong time to go in and step in and buy equities. So let's have a look at where the real rates are. We are very close to 2%. We haven't updated for Friday, but it hasn't changed very much. So the question is 2% really enough for the time being? And I probably think that it is. I think we are in for a period of stability and maybe even slight retracement back down to around 190 or something like that. I don't think that we're going to see 225 for the time being. And if we look at the term premium, this hasn't updated for a week, but I think that this kind of 50 area is going to be enough for the time being. And we don't have any auctions now, and I think that unless CPI next week is bad, and I can't see it being bad because the curve is already priced hawkish, that we are more than likely to see some retracement, some mean reversion in that, down to something like the 40s or even the high 30s. So I think that we're in for a period of stability in the bond market, or even for the longer end to do better, but I'll analyze that in more detail. Having listened to what Powell had to say last week, I don't think he's in any hurry to change his mind about the fact that the Fed is restrictive. And I think that the fact that the markets are pricing such small odds that they continue cutting in December is probably wrong. But the CPI next week will give us much more information about that. And I think that the curve will remain pretty flat for the time being, and I'll examine that in more detail now. I have done nearly nothing in the yield curve since I got out here in 2s, 5s, and I've had no big positions, just trading positions. And as you can see, really 2s, 5s have done almost nothing for several months now, certainly since the middle of September. And that tells me that there is no pressure at the moment for more steepening. So that's 2s, 5s, 2s, 10s. Where do we get out 2s, 10s? Down here, right? And really nothing much is going on. Even 2s, 30s are not feeling any pressure, because they're now back to where they were back in August. So the curve has really stopped steepening for the time being, and this kind of action probably persists for a bit until we get the next impulse for the steepening. And the next impulse for the steepening can only really come if we get another cut, or the market prices in a cut in December, What is the market afraid of now? It's afraid of A, that there will be a pause in December, but B, that the SEP dot plots, summary of economic projection dot plots, which come out in December, will be significantly more hawkish than the ones that came out in September, showing far fewer cuts in 2025. Will that happen? I think to some degree it's likely to happen, because they have to consider that the policies of the Trump administration will be far more expansionary than the reality that we had priced in up to then, up to the election. But will they, is the question. I'm not so sure that they will. I think the market is probably getting too bearish at the short end. And the fact that the market is thinking that they're going to have far fewer cuts, i.e. keep the real Fed funds rate higher for longer, is the thing that is actually keeping the long end bid. So if you look at 30s, they've really done nothing last week, simply because they expect that monetary policy from the Fed is going to do the job. So Fed funds stay at 3.75 to 4%, where I think they're more likely to pause than not. Then why sell the 30s? Sell the 2s, you know? The 30s will be supported by the fact that the Fed funds are going to be in a real range of something like 150 to 175 basis points. Now that in anyone's book is still restrictive, right? So that is what the market is pricing in at the moment, the likelihood that there is a pause in December, and the likelihood that the dot plots are much more hawkish than the previous ones. Is that going to be the case? As I said, I don't think it's necessarily so, but that is what we're trying to price in, and we will price it in via the CPI next week, the PPI naturally, but those are unlikely to be deviating very much from expectations. And finally, after that, we only have one non-farm payroll and one more CPI and PPI, and then we have the FOMC on the 17th and 18th of December, and that's your year end. So we are very much unlikely, I think, to move very far in the yield curve or in the individual tenures before we at least NFP at the beginning of December. But let's have a look at the individual tenures. I think the 2s are probably in a pretty good spot. I think the likelihood of us trading up to the 200-day moving average, unless CPI is something ridiculous, are very, very low. At this, 427 level, I quite like them. I think the odds of them going higher, as I said, are very low unless the figures turn very, very ugly. Simply because if you do the maths, you would have to have some very, very big revisions to the SEP dot plots in December to justify anything higher than this level in 2s. 2s are much more likely to faff around here, wait for the 200-day moving average, and then in December come down again towards the 390 level. 5s are the ones that people like least at the moment, because they're normalizing the curve. They want the curve flat, basically between 2s and 30s, only around 25, 30 basis points. So that being the lowest level on the curve, as you can see, by about 6 basis points through, they're the ones that are doing the least. And I think that they will remain next week in this range between 430 and 406. 20 basis point range, trading range. I think that's all she's going to get. If we see this kind of level again, I'm going to be a buyer, 437. I think that would be, of course, unless the figures, CPI is ridiculous, then of course I then buy it. But 437 in fives, I think, is a good level to get in. And tens, I'm not that bearish on 10s and 30s at the moment, simply because I think that you have a chance, and this is 720s, which is basically TY against US, you have a chance to see term premium again at this kind of level. This is basically a pure term premium play. As I showed you that chart, I think there's a possibility that we go to around minus 26 or something like that. And that will be a good level to get into 7s, 20s, i.e. buy TY and sell the US. I think that would be a wonderful level to get in, and really you are unlikely to lose money whatever happens in the December FOMC, because it's pushed so far. So I've marked this on my trading chart, and I'll be automatically buying TY and selling US at this level. As I've been telling you for several weeks, the yield curve is far more likely to keep on steepening in Europe than it is in the US. And even in Europe, and this is 2s, 10s, we gave up last week right at the, to the tick at the level here of minus 24 in 2s, 10s. And I think it's far more likely that they consolidate and trade up for a while, which tells me again that the likelihood that we get steepening in the US in the next week or so are quite low. So I'm abandoning the idea of doing any steepeners until I see the term premium come in slightly and I see the TY US spread at the level that I just indicated, around 27. So I think that even Europe is going to have a period of stability in the yield curve and retracement. We might retrace all the way up to something like minus 6. And that tells me that really you don't want to be buying the short end for the time being. Nothing much is going to happen in the shats, and it's more likely that any big rally, or sort of big mild rally, is going to be at the long end, i.e. bunds and even the 30-year, which could trade down to here, something like 25, so that's 7-8 basis points. And I would have thought bunds can trade down to something like this, 227. So, what's that? 8 basis points. So you're not looking for big things, but if anything is going to happen, it's more likely to be rallies at the long end and apathy and stability at the short end. I continue to think that the differentials between Germany and the US keep on going out. This is 5s. It hasn't even traded 208. I think over the course of the next 2-3 weeks, you could easily see it around, this in this area between 208 and 218. And 10s, I think every time it dips towards 185, it's going to get bought, and we will trade 202 at some stage fairly soon again. The situation in Europe is completely different to the situation in the US, and the natural way is for these differentials to trade higher for the time being and maybe make a top around this, around 203 to 210 area, and that's probably enough. We have moved, best part of 50 basis points, and given the different economic realities of the two blocks, it's likely that at these levels you start making a top, but I think that it's just too soon to go the other way. I think the moving averages are setting up for a period of several months where we have higher differentials, and then we see in the new year, January, February, March, where we go again. But for the time being, I just can't see these differentials coming in anything other than a consolidation move. I think the primary trend is going to still be higher. And as I expect those differentials to trade up to the 202 or even 210 area, I still have to expect that we will then, when that happens, see the dollar at around the 106 to 106.25 area. I don't think that we break through it because the differentials won't allow it for the time being. But to me, it's almost a given that we test the top of this Bollinger Band on the weeklies, which is around the 106 or will be around the 106 level. So I'm still looking to buy dips in the dollar. You can see what we did on the election. We spiked up, we came back, we went and closed right on top of the Bollinger. So I think that we're going to be trading between a 104.40 and 105.50, 70. But I still think that we see 106 within a couple of weeks or something close to it. So I'm a buyer of all dips in the Dixie. What about Euro USD? It's actually the one that's most bearish. The yen is far less bearish than the Euro USD, and probably the Euro yen is going to trade lower as well. I would have thought that any kind of a bounce towards 108 is going to be a strong sell. And where would I cover? Well, I would cover here around the 106.50 area down towards the 106 area. This is not going to get broken in a big hurry. The 106 to 106.50 area, even on the weeklies, as you can see, is quite good support. And it's going to take a long time of building to be able to break that. But any rally up towards 108 is really a very, very good sell or a very good opportunity to buy put spreads for 3 months or something like that, because as I told you, I think those differentials are going to go out and Europe is really looking like a mess. So eventually I see it breaking down. I really cannot see anything but bad things for the euro for the time being. Well, with the election being over and probably some geopolitical premium coming out of gold because of the Trump win, we have a bit of a retracement, which is great. So what's it done? I think this is probably the first leg of a bigger leg move down. And if we say that this is the move, then I would have thought a 0.382 or a 0.50 retracement would be the normal thing. And while bonds do nothing and meander around, as I showed you, for a week or two, it would be natural for people to sell some gold and buy some US treasuries. And the move between gold and tips has been so violent upwards that it's absolutely normal for it to retrace. And if we do an ABC, I really would not exclude this 2570 level trading. By then the 200-day moving average will be slightly higher. So this is the kind of area that I think makes sense to, the first area that it would make sense to buy it on an investment basis, as it were. At the moment, it's still doing nothing wrong. It's still trading in a positive way. But I do get the feel that really gold needs to trade in this kind of area. Stop all these people out. There must be stops here and trade down here and then be ready to reverse. So to me, this 2570 area is the natural, 70, 80, 90 is the natural, sorry, 25, 70, 80, 90 area is the natural level to look to buy gold longer term. The commodity complex has completely shrugged off the election and the FOMC, and it really doesn't care. Oil is basically doing nothing but trading between 70 and 72 and showing complete stability. And if you look at DBC, what is that showing you? Nothing. It's basically trading 2% away from where it opened the year, and it's showing absolutely zero signs that there's going to be any kind of inflationary pressure from the commodities sector anytime soon. It actually closed down on the week, didn't it? So I think that the fact that DBC is so relaxed and going so sideways and really just bouncing around between technical levels and showing no trend whatsoever tells you that CPIs and PPIs, I mean, how high can they possibly go? And therefore, the belief that the Fed has that it's still being restrictive, although financial conditions are actually very loose, the only way they're being restrictive is by having Fed funds, real Fed funds at a high level. But then the question starts, is anybody borrowing at Fed funds? Are they all just borrowing at the very long end or at the, in the middle of the curve around the 5-year area? And yes, there the real rate is just below 2% or 2%. So is that really restrictive for this economy? Who knows? But certainly the economy itself is showing no signs that 2% is restrictive for it, and therefore I just can't see much pressure on commodities anytime soon to start moving upwards. It is what it is. They are just dead in the water for the time being, and I think it's likely to continue. I've looked at every single chart, including copper, and that came down last week because tariffs on China from the Trump administration are likely to be bearish for it. But really, it's a nothing burger. It keeps on trading in a small range, zero trend here as far as I can see, and therefore no real pressure on bond yields. I just wanted to show you an SPY chart going all the way back to the very early 2000s or even the 1990s, and there isn't a single point, not a single point, where the market trades above the weekly Bollinger Band and then it doesn't retrace within 2, 3, 4 weeks all the way back down to the middle of this line, which will be about, could be around here, 575. So what am I thinking in equities? Well, let's triangulate with what I'm thinking in bonds. I think a period of stability in bonds, the long end not moving very much, certainly the short end not moving unless the S&P in December is very different, which I don't think it will be, but there's a long time to go between now and then. So what are equities likely to do? I think they're likely to keep on pushing, and let's turn this to a 1 day. They're likely to keep on getting people in, but really having smaller and smaller and smaller daily moves, and then whoosh down all the way down to about this kind of level, 585 in the SPY. That is, to me, the most likely. They're going to get people longer and longer and longer and longer, and we will be above the weekly Bollinger Bands for a week or two, and then we come down. That's one scenario, and that is frustration through price. The other scenario is that we just trade around for 3 weeks, and that is frustration through time. In either case, I think it's going to be very difficult to break this level, 586, 585, 586. That is going to be support for any dip, and that is where people are going to be very happy to buy it. It might even be this 590 level, but that is really not so important, where if it's right there or right here. But what I'm trying to tell you is that equities have repriced for a reason. They've repriced to a 15% corporation tax, which has been the policy that's been most announced by Trump. So that's where he wants to get the corporation tax, and we have repriced exactly as much as that cut would allow. So now we have to ask ourselves, well, what are the odds that that cut comes through? Well, they're not 100%, because you never know what could happen between now, his inauguration, and them deciding actually where they're going to cut it to when the new Treasury Secretary looks at the books. Certain things are going to be possible and certain other things are not going to be possible, and there's going to be horse trading and there's going to be arguments. So it's not 100%. It might be 99, but it's not 100. I think that at this level, you really do not want to be buying equities, or if you are buying equities, you definitely want to do some call substitution and buy calls over, so you sell your equities and you buy some calls, and if you lose 1% or so because, they don't go anywhere, so be it. At least you haven't been frustrated to hell. So I am absolutely positive that over the next 2 or 3 weeks, you're going to get either frustration through price, i.e. it goes down, or through time. Exactly the same touch of the weekly Bollinger Bands in NDX, but that tends to be far less precise, i.e. it can go through it 1% or 2% without any problems. It does come back, but it just goes through it further than SPX or SPY do. So just be aware of that. Where's the first level that I would buy the dip? 20,800, but that's probably too obvious a level to buy. In any case, I think the market will frustrate people by doing really strange things. And the reason why I think that is because we got the first close on the weekly basis below 4,850 for a long time. And in the stocks, and we even got a monthly close below 4,850. To me, that is likely to trade down towards 4,640 again, and which is around this level. Not immediately, but over the course of a couple of weeks. I think it's going to be a good risk-reward buy there. But if that is likely to come down, it's very unlikely that the SPUs can keep on motoring higher. They can go up 0.5%, another 0.25%, frustrate people, get them longer and longer and longer, and then spit them out with a 1-2% move in a day. And that is precisely what I think is going to happen here. You're going to get some more trading around, then a quick move down, which should be the buying level, and then it can rally again. So if I triangulate what the other markets are doing, so the EM, for example, which I think is going to trade back down to 42.25, and all these other foreign markets, so the Nikkei, it's looking very tired. It looks like it probably wants to take out these stops down here. I still think it's in long-term uptrend, but what I'm just saying is that I really wouldn't push it in the next couple of weeks, not even in US equities, which are by far the most bullish. I think you are likely to be frustrated. I am just stepping back, And really probably the only thing that I'm going to do is I'm going to strategically sell some puts on dips struck at levels that I would like to be a long-term holder at. But I really don't think that even that is going to be a fantastically profitable strategy over the course of the next 2 or 3 weeks. I think that whatever you do, you're going to be frustrated. So let's examine how best the market is going to frustrate you via the VIX. And this is probably the most likely scenario. It keeps on going down for days, 4, 5, 6, 7 days, and it goes down to 13 or even 12.45, which would imply that slowly SPX goes up, and then in 2 or 3 days it comes back and fills the gap towards 18. So what does that tell you? That tells you that the market for a few days, who knows, it could be even a couple of weeks, keeps on grinding up, pushing up against the weekly Bollinger Band, slightly through it, and then in literally 2 days gives up everything it's gained in 3 weeks. That's the likely scenario to me, and I am convinced that if you buy equities here, you want to be trading them with tight stops. You do not want to be investing in them for the time being. This is, I think, precisely the wrong time to be buying them. You will get 2-3% better levels. I am absolutely convinced. Just a final word about the transportation index, and that has definitely broken higher. What do I think it does? As you can see, it's through the weekly Bollinger Bands. I think it does exactly the same and frustrates you just like the SPY. Eventually comes retest this kind of level, 16,700, 1, 2, back down, and then it goes. It could take a month, maybe even longer to do that, but I think that that is the general trend. You want to be buying dips to around the 16,800, 900 level, and however you do it through whichever ETF, I think this is going to be a profitable position next year, because as I showed you last week, this kind of move on top of this one, it's going to be around a 20-25% move up. So I'm longer term, no doubt I'm bullish, but short term I think that frustrates you as well. Probably least of any of them, but still frustrates you. I've changed all the relevant levels. I don't think the US yield curve is going to steepen. I think it's probably more likely to flatten as time goes on for the course of the week, and after CPI we see. I still prefer to be long of German bonds rather than US bonds. I think that differential still goes out. I think that still pushes the dollar up. So I'm a buyer of dips, and I think that that still is likely to push gold down to do an ABC to around this 25.75 level, which I would really like to buy. That is probably more hope than anything else. But the fact that the Nikkei, the stocks are not looking, and even EM are not looking good, tells me that SPX and NDX are going to frustrate us. The upper weekly Bollinger Band is going to be around 60.40 SPX, and since the differential is about 27, I believe, to ES, every time you see it at 60, 65, 60, 70, you really do not want to be a buyer of ES. You just want to walk away, because the risk reward at that level, if you bought a dip and you get to 60, 70, your risk reward becomes very bad indeed. I still think that volatility is likely to dip to around the 13%, because there is just no reason to buy it for the immediate future. But I think at some stage over the next, I don't know, month or so, it'll trade 1880 again on the VIX and fill that gap, and that will be your opportunity, I think, to buy some longer term positions in equities, because then the frustration should be over, whether it's in price or in time. Thank you very much indeed, and tweet you tomorrow.